Hi, Arnold.
Hi, Will.
How you doing today?
Well, I'm surprised to be on your show. I always think of free will as having a being place for bright, young, good-looking philosophers, and I'm not a philosopher.
Well, you are not a philosopher, which is exactly why I want to have you on today, because I need an economist, and I'll tell you why. I got a Facebook message from my senior prom date, who asked, she's like, Will, do you understand the economy? Can you tell me what's going on? And it's not like I talk to my prom date very often. So people are suddenly interested in why the economy is doing what it's doing, why there's this talk of this bailout, what happened in the financial sector. And I can try to explain it, but I don't do it very well because I'm a philosopher, not an economist. And so I wanted to talk to somebody who really knows what we're talking about. So welcome, Arnold Kling. I should say, for those listening in the podcast, I'm Will Wilkinson at the Cato Institute, and Arnold Kling, who happens to be an adjunct at Cato, is here to talk to us, but he's got a lot of very specific areas of expertise that are pertinent to the current meltdown. So can you tell us a little bit something about your history, Arnold, and sort of where you come from and why we can trust your insight in this topic?
Okay, sure. Well, when I was in college, I told one of my philosophy professors I would want to go to graduate school in philosophy, and he said, no, you don't. And so I ended up going to graduate school in economics. And a year ahead of me was a fellow named Ben Bernanke, who some people have heard of. And subsequent to that, when I got out of grad school, I worked for 6 years at the Federal Reserve, another institution people have heard of. And then I worked at Freddie Mac. And while I worked at Freddie Mac, no one had ever heard of it. Now everyone has heard of it. And so that might be the relevant background, although all that's kind of ancient history. I left Freddie Mac kind of 1997-ish.
Yeah. Well, still, I think, I don't know anything about the mortgage industry. I've never even tried to get a mortgage. I've never owned a house. And my understanding is that the current unpleasantness all is rooted in the housing sector, that the housing bubble was the beginning of the problem, and that everything's sort of gone downhill from there. So can you tell us a little bit something about your understanding of why there was something like a housing bubble in the first place? Were there policies that helped facilitate the bubbliness of that sector of the economy?
Well, I think of the situation as in terms of a term called leverage, and maybe I should explain what financial leverage is. If you would like to buy Microsoft stock and you have $10,000, you can actually buy $20,000 worth of Microsoft stock by putting down $10,000, and your broker will lend you the other $10,000. That's a margin loan. That's called buying stock on margin. And that is a form of leverage because you're making your $10,000 do the work of $20,000. Well, in housing, we do that all the time. You put down, in the old days, you put down 20% for a loan, and you'd get, $20,000, you get a $100,000 house. Well, there's leverage of all types in the financial sector, and so in housing, we start out with the home buyer having leverage. That is, they've got sort of more house relative to the money they've put in. But there are various ways that later on in the process, investors add leverage, and leverage in the sense that there's a lot of they can make themselves a lot more sensitive to things like interest rates and home prices than the ordinary borrower would be. But I'm getting a little ahead of my story, so that's the term. Leverage, and that's important.
Okay.
And eventually we'll get to a term called derivatives, which is another part of the story. But let's kind of build a pyramid, as it were, of the mortgages. So you start with the home buyer. You've got the house at the bottom of the pyramid. And then you got a mortgage on top of that. That's a loan collateralized by the house. And then you've got a security that's backed by the mortgages, and then you've got derivatives, which are carve-ups of the mortgage security or guarantees that might be added to the mortgage security. So you've got these four layers. You've got the house, the mortgage, the security, and the derivatives. And leverage tends to go up as you go up. And the way leverage works is when it works really well for you when prices are going up, or when whatever you're betting on pays off. It pays off well, and then but it hurts you on the downside. So you pile up this leverage, and all it takes is a little bit of adversity, and you can get some really kind of horrendous financial redistributions and on the downside. Okay, so you asked about the housing bubble, and my view of what caused that was the big increase in low down payment lending that took place probably starting in around 2002, 2003. I mean, there was a sort of a gradual increase up to that, but a big increase after that.
What precipitated that? Why wasn't that happening before?
A number of things. I think there were some regulatory impediments to that. In particular, you couldn't have, I think this is true, I'll have to check, you couldn't have both a subprime borrower and a low down payment. You couldn't do that to the same borrower. So let me maybe back up a little more and talk about, if you don't mind, the three C's of credit risk for mortgage loans, how they're underwritten. So there's one C that's called character or credit, and that is looking at the credit report and saying, does this person show a history of managing credit responsibly or not? So that's character, that's one C. The second C is capacity, and that's, does this person have an income that makes it plausible that they'll be able to meet the mortgage payments? And the third C is collateral, and that's the equity that the person has in the house. And until you make a down payment, you don't have any equity in the house. And if you have a 20% down payment, which used to be traditional, you have a pretty good stake in the house. And if you put down only 2%, you have less. And when I was at Freddie Mac, when I developed models to price mortgages, most of the focus was on the collateral piece. That if you, because we figured that if you had 20% equity in the house, then unless the price of the house declined by more than 20%, we were not going to own the house. Because if you got in trouble and couldn't make the payments, what you would do would be to sell the house. You're not going to, you're not going to let us have it. So the collateral piece was considered the most important back in the day, and so.
Was there a change in sort of professional opinion about how important collateral was then?
I believe there was. Not within the experienced mortgage lending community. But what happened, and actually I was kind of a big part of this right around 1990, was that the first C that I talked about, the character or credit, we switched from human underwriting to credit scoring, which was more accurate and cheaper. So we did that, but what that set the stage for was private, non-Freddie Mac, non-Fannie Mae, I call that private sort of mortgage lenders, investors, picked up on credit scoring, and they started experimenting with it, and they started to use it, and it worked really well. But what they didn't realize was that the reason that it seemed to work so well was that house prices just were steadily rising, and as long as house prices are increasing, you don't even have to underwrite the loan. Anything works. So they didn't. So I don't think they factored in the collateral aspect. I think at Freddie Mac they still did up until 2003 when there was a CEO change. And the new CEO was more responsive to sort of political pressures or to extend loans, so-called affordable housing loans, and so he was willing to take a plunge into low down payment lending. So that was sort of more of an accident of history, but the private market got, because they had this credit scoring tool and they thought it was working really well, they were willing to sort of rush in where angels fear to tread into these low down payment subprime mortgages. So when you have lots and lots of loans being made to people with like 3% down, 2% down, something like that, you're setting up a world in which the only equity people have in their homes comes from house price appreciation. So when prices are rising, anyone can buy a home. And when prices are not rising, no one can buy a home. So during the anyone can buy a home phase, more and more home buyers were entering the market, and as more buyers enter the market, prices go up. As prices go up, you have this environment where you can lend to anybody and get away with it, so more and more borrowers are brought in, and it becomes a virtuous cycle until you kind of run out, until the process runs out, it stalls, and as soon as it stalls, it goes into reverse. So the low down payment trend created a very unstable mortgage market, or housing market. It led to a bubble on the way up, and it led to a crash on the way down. I think that the blame for the low down payment lending belongs equally to the private sector and to Freddie Mac and Fannie Mae. My issue with Freddie Mac and Fannie Mae is they knew better. They'd been in the business longer. They'd been through periods of house price declines. And I know for a fact that Freddie Mac, we had in our pricing models factored in the enormous capital requirements that you need to be able to protect yourself in a downturn if you have a low down payment mortgage. And obviously they did not set aside the capital commensurate with their plunge into low down payment and subprime lending.
Wow. See, it's already complicated at the first, and this is just like the first step of this story, Arnold. So you see why it's difficult to convey the whole complexity of it. So here's something I don't quite understand still is that you say that the trend of offering mortgages with a low down payment was a consequence of the success of credit scoring. But there's and am I right that your point was that the sort of automatic credit scoring, the success of that was partly an illusion created by the strength of the market at the time when they were assessing it?
Exactly.
Is that
exactly?
Right?
That's the exact point.
Okay. All right. Okay. So now I've heard a lot of people, and this is a point that's popular with some libertarians, is that part of the housing bubble. So here's two points. Part of it simply has to do with the incentives that the government puts in place to have people buy homes. So there's big mortgage deductions and so on and so forth. So one would think that would facilitate a lot of buying. Second, I've heard just a lot of people mention the idea that the Fed kept interest rates low for so long, which made money very sort of cheap to borrow for a long period of time, and that the confluence of these things sort of helped inflate the bubble. How much weight would you put on sort of policies like mortgage deductions, policies like the Greenspan's behavior as chair of the Fed in the sort of early part of the aughts? How much do those have to do with the bubble?
I personally put less weight, than other people. I think you want to gear interest rates toward the general economy. You don't want to throw the economy into recession just because you think you got a housing bubble. If you think you have a housing bubble, you should use regulatory tools to address that. You could require, for example, they could have looked at this low down payment lending and said, this is an accident waiting to happen, so let's put regulation on it. That would have been the best way to stop it.
Mm-hmm. Well, so what kind of regulation in particular would be the? Well,
you could tell. Well, for example, any bank that holds loans or securities backed by low down payment mortgages, you could require higher capital requirements, and that would drive them out in a minute. Or you could tell Freddie Mac and Fannie Mae, to stop buying them. But actually, at the time, the regulators were doing the opposite. Andrew Cuomo, as Secretary of HUD, increased the goals of Freddie Mac and Fannie Mae in the so-called affordable housing area and basically almost forced them to go into low down payment lending in order to meet those goals. So the policymakers did the opposite of what would have been effective at curtailing the low down payment lending and slowing down the bubble.
Well, here's a just a riff from me on. Partly making loans easier for people with mediocre credit to get. That doesn't seem like the worst thing in the world. That a lot of poor people are credit constrained, and if they have access to credit, it'll actually really make them better off over the long run. So that might have been helpful to a lot of people. That's one thing, but the other thing that I suspect is that that a lot of these policies that have to do with being able to get home loans, making it easier for people to get loans, and subsidizing people's mortgage payments and so on, has to do with a sort of like a cult of homeownership, a cult of rootedness that Americans have. The idea of buying a house is the American dream, and so I kind of wonder about the extent to which the idea that a really good life, the most meaningful kind of life, is one in which you're sort of anchored to a piece of real estate where you are, tightly tied to the local community. You raise your children in that house. You have, birthdays and Christmas there. It's a repository of warm memories, yada, yada, yada. And this sort of romance of the home is at the root of our financial devastation.
Well,
what do you think of that?
Not much. I'll push back in this sense that one of the virtues of home ownership in this country is that it's a form of forced saving. There are very few things that you encounter as a consumer that induce you to save, and a lot of things that induce you to spend. So I think one of the defenses of home ownership, and I think it's a valid defense, is that for a lot of people it's the way it's forced saving. So I don't think, that's not to say that home ownership isn't overblown in this country, and that, but I think the effect of the home ownership cult is more on the attitudes of policymakers, particularly when as the housing bubble went up. They just got happier and happier, as opposed to raising concerns. They said, "Oh, look at what the home ownership rate is doing. Look at what house prices are doing. Isn't that wonderful?" They didn't think ahead. Let me back up on one point. The one thing where I do think we have a very peculiar policy focus, and that is on subsidizing borrowing to buy a home. If you think about it, that is a weird thing. There are actually, I think it's Australia, but I may have it wrong. I think there's one other country, when they subsidize home ownership, what they subsidize is the down payment as opposed to the mortgage. Why you would want to subsidize the mortgage, why you would want to subsidize indebtedness is really peculiar, and I think that's more of a political public choice story than it is a valid public good story, because it's not a public good. You can make a case that I benefit from you having a home because I think you'll take care of your lawn better and maintain your house better, and if you're my neighbor, that'll make my house worth more. But I don't know what benefit I get from you having a big mortgage, from you being heavily in debt to buy a home. That has no public benefit at all, and why we subsidize that, I think there's a public choice story which I could get into with you. I probably will at some point.
Briefly, what do you think that is? Why would you? Who benefits from that?
That goes sort of as we talked about the layers in the pyramid. Now there was a time when the beneficiary was the mortgage lender, when it was your neighborhood savings and loan, and they made their profits on mortgages, and that was okay. It wasn't anything spectacular.
Yeah.
But when securitization came in, that is, the loan, instead of sitting at the savings and loan, gets packaged with other loans and then gets put into a security that gets traded around from investment bank to pension fund to whatever, that's when all the fun came in, especially for Wall Street. Wall Street had huge trading profits and just fees in trading mortgage securities. And so I refer to it as the GSE Wall Street industrial complex. They have the GSEs are government-sponsored enterprises, Freddie Mac and Fannie Mae.
Let's back up and explain what the GSEs are.
It stands for government-sponsored enterprise, and it means Freddie Mac and Fannie Mae. And that is my cell phone that is causing that. So all I have to do is turn it off. And if that's some congressman calling, we blow them off. Okay, so GSE is government-sponsored enterprise. It means Freddie Mac and Fannie Mae, basically. And they would buy these mortgages and sell, and then create the securities, and the securities were sold by Wall Street. And Wall Street made just a lot of money at that. And I think to this day, Wall Street is in denial that model is dead. Someone like Henry Paulson probably cannot internalize and believe that mortgage securitization is dead. But I think it is.
Okay, so answer some sort of more basic questions for me. Then, why do Freddie Mac and Fannie Mae and Freddie Mac exist at all? Why can't people just get mortgages from their local banks, from other kinds of mortgage brokers? What is the function of these sort of like government-sponsored yet privately owned enterprises? Why are they there?
Okay, well, we'll have to give you a history lesson for that. Okay, it's the 1930s. Lots of banks and S&Ls have closed. The government says we need to find some way to get mortgage money to people, so they create Fannie Mae. And Fannie Mae is this national government agency, an agency of the government, that will buy loans made by small originators. Okay, so you've got so that you have them. In somewhere in the 1960s, I think around 1968, Lyndon Johnson is kind of desperate to not show the government as having added another zero to its balance sheet, and so they sell Fannie Mae to private shareholders to kind of improve the government's balance sheet. So now it's got private shareholders, but still.
So like we've sold the Army.
Yeah.
To a private firm,
then
all of a sudden the budget would look a lot better, right?
Yeah, the Department of Education, whatever, as long as they got to be able to make money. I mean, the thing about Fannie, otherwise the you might not pay a whole lot for the Department of Education as a private investor, but
I wouldn't pay anything.
Okay, so but Fannie Mae was worth something, so they got bought, and so they're now owned by shareholders, but with what everyone called an implied government guarantee. Government's never going to let them fail.
Right.
Freddie Mac is created in 1970 to address an imbalance of mortgage funds, where there's funds available on the East Coast, but where they need funds is on the West Coast. And at the time, the regulations of the savings and loan industry you couldn't sort of originate a mortgage across state lines. So they came up with the idea of you could originate the mortgage in California. Freddie Mac would set up a pool of mortgage loans, and they could be sold to somebody in New York. So that was called the secondary mortgage market that Freddie Mac created. So that was the original securitization. Fannie Mae was just holding its loans, its mortgages in its own portfolio, like a giant savings and loan. But Freddie Mac originated this securitization. And
so it actually created a new market that didn't exist before.
Right. It's called the secondary mortgage market, where some mortgages could be pooled and traded and so on. And during the S&L crisis, as the savings and loans from late 1970s, early 1980s were dying due to the high inflation rates that no one had anticipated back 10 years ago when they'd had issued mortgages at 6%, and now you had inflation at 10%, and that didn't work.
Mm-hmm.
So the S&Ls were going out of business, and on their way down, in their desperate attempt to save themselves, they securitized out everything they could to try to raise cash. So securitization really took off, and then when the S&Ls were out of business, there was kind of nobody else to make mortgage loans, so securitized mortgage lending really took off. And in order to prevent another savings and loans crisis, the regulators put pretty hefty capital requirements on banks and savings and loans trying to make mortgages. So the result was, from a regulatory perspective, it was relatively unprofitable for banks to make mortgage loans and relatively profitable for Freddie Mac and Fannie Mae, at least within the market segment that they were restricted to by law. So they
took
over.
Didn't have the same capital requirements that other banks did.
Right, and so they took over the segment. It's like in an ecological setting, if you create an animal with no predators, imagine it just taking over the entire ecology. That's kind of what Freddie Mac and Fannie Mae did in the mortgage market.
Okay, and their relative advantage had to do with having a certain sort of protection against the regulation that applied to basically all other lenders.
Yes, the term is regulatory arbitrage.
Regulatory arbitrage.
Mm-hmm.
Word for the day.
Yep.
Okay, so let's talk a little bit more. Then I'm actually feel like I'm starting to get some of this. Securitization. You are a bank. You write a mortgage for me, right? I'm buying a house. You give me a loan. Now I owe you money. What does it mean to securitize the loan? That what do you do with it as the bank? Where do you go? Because now you are holding potential profits, if I pay off the loan in the way that I'm supposed to, but you also bear some risk in case I default on the loan, etc. So what is happening when banks write loans and then sell them to someone?
As a bank, I don't want to bear the capital burden of having to hold your loan. So I sell the loan to Freddie Mac or Fannie Mae. And let's say it's Freddie Mac. Freddie Mac takes a whole bunch of other loans that were originated about the same time, about the same interest rate, and packages them all together in what's called a mortgage pool, and sells a security backed by the mortgages in that pool. Freddie Mac guarantees that there won't be default cost borne by the security holder. So if you default on your mortgage, what Freddie Mac will do would be to pull the mortgage loan from the pool. They will pay the security holder in full for that mortgage right then and there. So if you owe $100,000, Freddie Mac right then and there pays $100,000 to whoever holds that security.
So they basically sort of rinse out the risk.
Absolutely. That's how they made the secondary market work. It wouldn't work otherwise. You can't have somebody in New York trying to figure out whether somebody in California is going to default or not. It just, the market wouldn't trade. So that's actually a key role of financial intermediaries in the economy, is that they absorb risk and they sort of trade their reputation for transparency. You never have perfect transparency. Every time you add a layer like that, you take away a little bit of transparency, but you substitute reputation for transparency. And
okay, so as long as all the people who buys these secure? So Freddie Mac creates these pools of mortgages. They sort of bundle them together into a package, sell the package, and they're selling that to who?
Okay, I think it originally gets bought by a Wall Street firm. Okay, typically I don't think Freddie Mac would sell directly to any other investors. They would sell to one of the big Wall Street investment banks like Goldman or Merrill Lynch, or it used to be Salomon Brothers, things like that. And then the investment bank then turns around and tries to find customers for it. They could be pension funds, money managers. I mean, there are all sorts of insurance companies. There are all sorts of foreign investors. In fact, a lot of foreign investors were buying Freddie Mac's and Fannie Mae's in recent years to try to get a slightly higher interest rate than Treasuries, but they were assuming that they were as free from default risk as Treasury.
Mm-hmm. So if I'm and I'm trying to get a picture of them. So if I'm like at Goldman or Lehman Brothers, and I'm buying a bunch of mortgage-backed securities from Freddie Mac or someone like that, is my sense then that basically what I'm buying is Freddie Mac's assurance that the risk has been rinsed out, more or less?
Exactly.
And that I have some sort of expectation of an assured return?
I wouldn't say assured return. You have
okay. So
what you're assured to get are the cash flows from the mortgage. So as Will Wilkinson makes his monthly payments, those monthly payments will flow through to the owner of the security. And again, with the exception that if Will defaults, all of a sudden Freddie Mac steps in, pays off the loan into the security, and then Freddie Mac has to figure out how to recover its loss from by foreclosing on Will's house. So that's, but it doesn't guarantee you a return because there's still plenty of things that can happen that can make the value of that security go up and down. Interest rate changes can affect the value of it, and things like that.
So I'm guaranteed the flow that comes from payments on the loan. All sorts of and that flow that's coming from the original loanee can be worth more or less depending on various circumstances.
Exactly.
Okay. But it seems like the idea here then is, but it's people were thinking that it's incredibly secure, that it is really low risk.
Right.
But it turned out to not be. I mean, so is what happened is just like the housing bubble that occurred that then started to cascade through the system. Was that just a highly improbable event? So that what has happened is nobody was actually making a misestimation of how much risk there was in the system. It's just that the lightning struck, that the incredibly improbable event happened. Is that what? Or were people fundamentally misunderstanding how much risk there was in these securities?
Lots of questions. Let me back up, sorry.
Yes,
First of all, in addition to Freddie Mac and Fannie Mae, there are private securitizers. They don't have the reputation that Freddie Mac and Fannie Mae have. Freddie Mac and Fannie Mae sell on the basis of their reputation. With private securitization, you don't have the reputation. They carve the security up into what are called tranches. And this is where kind of you hear about the rating agencies. The rating agencies say this will be a AAA tranche or a AA tranche. So that's where they make their little cameo appearance into the story. The idea of the tranches is to try to concentrate the risk into one particular class of holders of the securities. So you have, let's say, 100 mortgage loans in a pool, and the first 10 defaults go to this or the loss is borne by this investor, and only if there are more than 10 defaults do some of the other investors have to worry. That's what carving that risk up is. So the idea is that the so-called senior tranches, the guys who don't get hit unless there are a whole lot of defaults, those guys can treat it as risk-free. They can treat it as if Freddie Mac or Fannie Mae were guaranteeing it because the chances of more than 10 defaults are really low. That was the private securitization model. Okay, that model, I think, blew up first. It blew up late last year and early this year because they were getting more than the defaults that the senior people thought they were protected against. So the senior people, well, first of all, the junior people were getting wiped out, the junior tranches, and the people who had the senior tranches were starting to lose money. And so, and some of that seniors stuff was held by companies that were in the business of creating these private securities to begin with. So some of the companies themselves went under, and so everybody's starting to back off of that stuff. And then as time went on, because Freddie Mac and Fannie Mae had plunged deeply into the subprime low down payment stuff, they started suffering losses. And so these investors were looking around and said, well, gosh, a lot of us are friends, and maybe some of us, we ourselves got burned in the private securitization market. Freddie Mac and Fannie Mae are taking losses. They can't take losses forever. I think they'll still be around, but I don't want to be the last one to pull out. It's like a bank run situation. If I think my bank's going to be okay, but I don't want to be the last person to pull my money out of the bank if it's not insured and if the bank's going to go under. So you had what amounted to a run on Freddie Mac and Fannie Mae this spring and summer. And when that happens, it's a self-fulfilling crisis for Freddie Mac and Fannie Mae, because a run on them means that in order to raise money, they have to pay a very high risk premium. And if they have to pay a high risk premium, then they don't make profits. And if they don't make profits, then they're going to lose money. If they're going to lose money, then people are going to pull money out. And so you can see that it becomes a vicious cycle. So it's a classic bank run. I describe financial systemic risk consists of people as individuals making contingency plans that make sense to them as individuals, but that cannot be executed collectively. So if as individuals, these investors all thought that they would pull out of Freddie Mac and Fannie Mae before anything bad happened, but collectively they couldn't really execute that, and as they tried, it became clear that Freddie Mac and Fannie Mae were not going to, that the only way that they were going to make good was if the government bailed them out.
So I understand what happens in a literal bank run, which is just all the depositors start taking their money out. In this case, was it simply just that everybody who owned these securities started to try to ditch them?
I think some of that happened, but what hurts Freddie Mac and Fannie Mae, they're not hurt if their securities that are trading in the secondary market lose value. I mean, it's not good for their prestige.
It's if people don't buy new ones.
It's if people don't. Yeah, they won't fund their debt. I mean, Freddie Mac and Fannie Mae have to fund a lot of their activities just by issuing their own debt, and if they can't issue, and if their own debt is, comes at high interest rates, they can't operate.
So who is the creditor to Fannie Mae and Freddie Mac? Who's propping them up?
I'm not sure what you mean by propping them up.
I mean, you say they have to.
They need to be
bailed out. You're saying that they have to have access to debt themselves,
right?
And if they don't have access to it, then they're not going to be able to do what they do. So they issue their own. What do they do? What do they sell? They sell
bonds, just like Treasury bonds.
Just bonds, just like Treasury bonds.
5-year bonds.
And those are just sold on the open market, and just lots of other and people like investment banks own them.
No, mostly like
sovereign wealth funds own them.
Anyone who invests in bonds, so insurance companies, foreign banks, foreign governments, the whole money market, and it could be anywhere.
Yeah. So if
those people
Fannie and Freddie completely tanked, then there's all of these investors holding these bonds.
Right, and if
that
what
now can't be redeemed.
Yeah, if Freddie Mac and Fannie Mae declares bankruptcy, then a bankruptcy judge decides who gets what. and it could take years. And meanwhile, they're frantic, and all sorts of it's really pretty chaotic. So to prevent the bankruptcy, the government created this what they called a conservatorship, where the government said, "Right, we'll do the borrowing for you." Okay, so it isn't Freddie Mac and Fannie Mae's name on the borrowing anymore. It's really the government. I mean that's not literally
US
true, but
Treasury bonds now.
Yeah, it's not literally true, but it's as if they'd done that.
Yeah. Excellent. I feel like we're getting somewhere. So now what happened to tell me what's a credit default swap?
As far as I know, it is a bet that another company is going to default. Mm-hmm. Okay, so if I think AIG is going to default, I make a bet that it's going to default. And one reason I might make that bet is if I am a creditor of AIG. If I've lent money to AIG and I want to hedge that bet, then I want to hedge my the fact that they owe me money and they might default. I make a bet that they'll default, and then someone has to take the opposite side of the bet and bet that they won't default. So does that help?
Yeah. So it's a credit default swap is just it's a form of short selling, right? But it has to do specifically with defaults.
Yeah.
Right?
Just be careful. I think an expert might come up with a better, more precise definition, but I think of it as it's sort of an insurance vehicle. Let's say, this whole mortgage security, especially the private securitization process, is this kind of layering on of protection. Mm-hmm. So I'm an investor that I basically want a zero risk investment. Let's say that's me. So I walk into you as Morgan Stanley or whatever. You say, well, I've got a senior tranche in a subprime mortgage security, and I say, well, that doesn't sound risk-free to me. What can you do? What can you do to make it better? What can you do for me? And you say, okay, how about I'll go to AIG and they'll give you insurance that this security will pay. And you say, well, that's pretty good. AIG's a good company, but what if they go under? What can you do for me? Well, all right, I'll sell you a credit default swap on AIG. So you can see that you sort of add layer after layer after layer to try to convince somebody that it's risk-free. And it's one of these things where individually all these transactions make sense, but then when something really bad happens and everybody's scrambling to try to make their obligations, they can't. And actually, let me make another point. This is a really subtle technical point, but these kinds of insurance products, they're often called options. Options, they're Robert Merton, a famous finance professor, not the sociologist, the finance professor, pointed out that there's an equivalence between an option and a dynamic trading strategy. In the 1980s, this was used to create something called portfolio insurance, where if I sell you a put option on a stock, let's say you own some Microsoft stock, you're worried that it's going to go down, I'll sell you a put option, which gives you the option to sell it to me at, let's say, $80 a share. And if it's right now it's at 85, then you can be confident you'll never go below 80. You've got this put option.
So it's a way of limiting my possible losses.
Yeah, it's like a stop loss order also. So it's a so what portfolio insurance was a put option on portfolios of stocks, and the way that the sellers of that portfolio insurance intended to make good on it was that if they saw stocks starting to fall, were going to engage in what was called program selling. They were just going to, computer program was just going to send an order to sell, every stock in the S&P 500 in order to sort of match, in order to use this equivalence between dynamic trading and an option. Okay, so individually, this portfolio insurance might have made sense, but when everyone tried to execute it at once, and this happened on October 19th, 1987, they couldn't, and the market the Dow fell like 500 points, which at that time was way more than a 500-point drop would be now. It was, I think, one of the biggest percentage drop, perhaps in history, certainly since the 20s.
So why doesn't the theoretical equivalence give you a real-world equivalence? Because
in the real world, everyone can't do it at once. The theory sort of assumes that you're doing it as an individual in a liquid market, and in practice, everyone can't do it at once. And these credit default swaps are, I think, backed by that same kind of dynamic strategy. That is, if I've sold you a default swap on a company. But I'll keep using AIG. They probably weren't an example of this. But let's say I sold you this default swap on AIG, and I'm sitting there just collecting my fees and not worrying. AIG is great. AIG is great. And then I start to get nervous about them, and I realize, I might have to make good on this default swap. I better hedge that. And the way you do that is you sell some of AIG's securities. So you sell some of their bonds or sell some of their stock. So the people who are providing these default swaps, as the companies start to go bad, what they do is they sell the securities of the company, which of course makes them go bad even more quickly. So again, you get this collective activity that makes what you thought was an individually sound contingency plan unable to be executed. It's another version of the bank run phenomenon.
Fascinating. Well, I think we've got most of the sort of overall framework in place. So is there any other pieces that we need to explain why the market is where it is now? Because then we can move on to talking about like the point of the receivership of Fannie and Freddie and these other bailout plans, and talk about how what would have happened had the government not stepped in. But do we need any other sort of pieces to grasp why we are where we are now?
I'm sure there are more pieces, and I'm sure there are actually a lot of pieces that I don't know myself. But let's move on.
Okay, in my mind, the sort of events that went down, the first big thing was like the sort of collapse and more or less buyout of Bear Stearns, right?
Right.
Is that like the first big event?
Yeah.
And then subsequently, we've had basically the nationalization of the explicit nationalization of the GSEs.
Right.
They were technically private, but sort of always implicitly government-backed. And basically what happened is the government just made their assurances explicit. The Treasury and the Fed let, say, Lehman go, but then stepped in to rescue AIG. And so there's all these... I can't make any sense of what the strategy is. Is there a strategy behind this pattern of government activity, or is it just kind of a free-form jazz odyssey?
Well, I don't think we should be surprised that they're making these decisions ad hoc, and I don't think we should necessarily be disappointed that they're making decisions ad hoc. Yeah. It's hard to have rules for a kind of a one-time event.
Absolutely.
So with Freddie Mac, I think the thinking at the time, the thinking with Bear Stearns is, if we just take some of these securities into the portfolio, take some of the worst stuff in the portfolio, then they'll be bought by someone else. And when you have a failing institution, the best thing is to have it be bought by someone else, because then there's continuity. They can keep running. Their counterparties can work. So that's the cleanest way. And the condition for doing that was to take some of the difficult to value securities off their books. And so the Fed said, fine, all right, we'll do that. Take $30 billion of junk, and we'll hold on to it and hope it isn't as bad as everybody's afraid of. And then Freddie Mac and Fannie Mae get into trouble. Their borrowing rates go way up, and the government says, this is stupid. Every day we leave them in business, they borrow at these ridiculously high rates, which means they bleed even more. If we're going to have to take them over, let's just take them over now before they bleed even more. and then we'll put them in this conservatorship, and maybe in a few years we can we'll reevaluate, see where we are. So again, I think from that on a one-off basis makes sense. Lehman, they wanted to do the same thing they did with Bear, but the potential buyers offered a pretty bad deal in terms of saying they wanted to the government to take an unacceptably large portion of the bad loans, and so the government just said, okay, we're not going to be browbeaten into it. We're going to pass on this one, and so they let Lehman go. AIG, because they're so, first of all, they're, as an insurance company, you don't want to have an insurance company go under. That creates a mess, and also they were so heavily involved in all these swap markets that the government or the regulators just decided that it would just be really ugly to have them go under, and that there's no one else could possibly really take them over because what they had was so complicated. And so they just said, all right, well, we're going to do this deal where I forget, all I know is that they're lending at a very high interest rate, they're getting a huge equity stake, and they'll keep their fingers crossed and hope that with government assistance they actually stay alive and they don't end up taking a huge loss.
All right, so there's not really an alternative to trying to make at each point in time there's a new decision to make, and then you try to make the best decision. But does this sort of create a sort of you were talking about how some of these investment strategies can be individually rational but sort of collectively infeasible. Can you get in a position where the government keeps making, in some sense, the correct choice at each choice point, but the pattern of choices that they make ends up being a complete, cluster?
I don't know.
Whatever.
Yeah, I don't know how to answer that. I mean, one fear is that you will encourage people to take risks, but I think every executive who's watched these bailouts has said, they're not saying to themselves, oh, now I want to be just like the guys at Lehman or Bear or whatever. So, and the shareholders for that matter either. So I don't know that. I don't know what the impacts are, the systemic impacts of those individual decisions.
Arnold, one of the things that just really fascinates me about this whole thing, for a long time I've been interested in specifically the new institutional economics, and they always make a strong distinction between the de jure institutions and the de facto institutions, and where an institution is simply the rules of the game, right? The principles that are governing exchange, that are governing the sort of political process. And this is a situation where you see the disconnect between the de facto institutions and the de jure institutions, right? The Fed and the Treasury were doing things unilaterally that I'm not sure they really have sort of the constitutionally, legally mandated right to do, but that doesn't really matter. It's what happens, right? And so you start to see the level at which you start to see what the institutions really are, like how the system really operates. And it's sort of disconcerting when you get down to the point where it's kind of the Fed and the Treasury are kind of running the country in some way. And only recently so Paulson thought he was going to get his plan through, and only recently did Congress be like, hey, wait, this has something to do with us. We're supposed to make decisions about the disbursement of public funds. You can't just decide this by yourself. That seemed to sort of annoy, I think, the financial technocrats. But and so now I think we're seeing the shakeout of a bit of resistance, a little bit of the checks and balances in the real system is happening, where Congress is asserting its authority. But it's amazing how much already got done without there being any involvement of the sort of what people think of as the democratic process.
Oh, yeah, absolutely. You pick up part of Bear, Freddie, Fannie, Lehman. Oh, don't want Lehman. AIG, and then they were talking about doing this bailout, without any legislation. Some big $800 billion thing. And then finally, somebody said, think we ought to vote on something. And so, Paulson then walks into Congress and says, okay, yeah, let's have a vote. His basic proposition is, okay, vote for this and nobody gets hurt. Sticks a gun in people's head. I don't know how much more democratic that was. And I'm not sure we want to see the democratic process at work here. I mean, I don't think, the phrase of the day is lipstick on a pig, and I think, Congress is putting lipstick on Paulson's pig. I think it's still a pig.
Yeah, well, I wrote a blog post to this effect that when it comes to the regulation of complex financial markets, I would rather, as sort of technocratic elite, be making the decisions rather than Congress, who has no idea what they're doing and will do what they do, which is try to win benefits for their constituencies. So I agree with you. It's not necessarily a better thing, but yet at the same time, you don't want you don't want to set the precedent that this part of the institutional structure, whenever it decides it wants to, gets to make decisions unchallenged. And I mean, it seems like the financial version of the fight that we've been having about executive power, where the president, when it says, well, when it comes to the war, I get to just decide. Whatever, I'm the decider. This is it. If I want to detain prisoners of war in a certain fashion, Congress, you don't get to say anything about that. This is my job. And this is another instance of, it's not the president exactly, but it's sort of the aggrandizement of the executive branch, that that the Treasury at least, who knows what the actual legal status of the Fed is. But I think it's, so my democratic impulses kick in the sense that I don't want to create the sense that the rules of the game, that if the rules of the game are that the Fed chairman and the Treasury secretary decide to do something, then it happens and then that's law. I don't really want that to be the real institution. So I want there to be democratic pushback. And the same, but at the same time, Congress will make worse decisions about this particular thing. So I'm a little bit torn.
Well, I guess let me try a different institutional slant.
Okay.
Basically, don't think of this as the democratic process, or what in 1776 democracy meant. Then it meant
right.
sort of a more very diffuse authority, equal authority. The people are not are not being empowered here. Okay. So it's not the democratic process. This is still very much the Wall Street GSE industrial complex. And this is still the same congressmen and senators who were bought and paid for by Freddie Mac and Fannie Mae and by Wall Street. And I think the whole point of the plan, quite honestly, is to try desperately to put Humpty Dumpty back together again, so that we'll somehow go back to mortgage securities issued by Freddie Mac and Fannie Mae, trading it with nice fees and profits on Wall Street, and it's I don't think it's any kind of check and balance. I think it's like a tight interweaving of big finance and big government. That's what I see.
So you don't like the Paulson plan, evidently, and so you think that but you think that if Congress steps in, which it is doing, and has to validate the plan, that the plan will just be the same thing in essence.
Yeah.
But will just have some pork thrown in.
Yeah.
That's
probably right. And realize that I'm an outlier here. Those of you watching at home should realize that Arnold Kling is an outlier. That most decent, upstanding people support the Paulson plan. And I would
Do they
say,
really? I thought it was pretty unpopular at this point.
It's unpopular
So
with like, average Americans. But I mean, when I'm saying decent, upstanding people, I'm saying sort of people in the upper socioeconomic strata, sort of very well educated people, highly paid people, I think support it. I haven't taken a poll. That's my impression.
Now I've heard. So I'm sorry. Go ahead.
And one comment, I said I went to grad school with Ben Bernanke. I have nearby a book that has an interview with him on the Depression. I read his book on the Depression. I think he and I both our theses were signed by the same thesis advisor. I mean, at different levels. Mm-hmm. And so we came from a very similar culture. There's something wrong with this picture that he's on one side of the bailout and I'm on the other side. And I'm not sure what it is. I've been joking to people that one of us is on crack. And, it's probably me. But, my sense is that this is a, sort of a public choice debacle, a continuation of what we've had for the past 20 years of sort of protecting the financial industry without really much public benefit. He may very well feel the other way. I would hope he does. I mean, I don't think he would set out intentionally to support something that only benefits this narrow group of people. So, if you want, I can get into what I think are sort of the three questions that I have about the bailout.
Yeah, so tell me your three questions, and then we're pretty much at the end of our time. So,
okay.
But I want to get to that. So let's talk about your main misgivings about the bailout, or at least questions about it, and what you think real helpful reform would look like.
Okay, let me actually jump ahead then. Let me just say that what are these bad mortgage securities doing? What harm are they causing now? What's happening is that their values go down. The banks holding them have to mark their values down to market values. That means they have to book losses, and that erodes their capital. That means that they bump up against regulatory capital requirements that say they have to curtail lending. And the nightmare scenario is they keep cutting back lending, and small business and everybody can't get loans. And there's very contradictory rumors from the Washington Post saying that's not happening at all, to CNN saying it's happening all over. So we don't know whether that's happening yet, and Ben would know much better than I sort of how close we are to that. Okay, so there are three places you can intervene with that. You can raise the price of the mortgage securities, which is really what the Paulson plan is designed to do. You can get rid of the market value accounting, which some people have proposed, but which I don't support, because I think it makes the regulator's job, the FDIC's job, much harder if they're not seeing mark-to-market values in the banks they're regulating. And the third thing you can do is you can have forbearance on capital. You could say, okay, going forward, go ahead and make these loans that you've been making, you would have made, that are good loans to small business, and we'll forgive the usual capital requirement for a short period of time. That means, as the FDIC, we're going to take more risk with you as a bank, but we'll do that for the sake of the economy. The advantage of that, to me, is, first of all, it can be done immediately. The whole Paulson plan will take months to roll out. Secondly, it is within a process that is well understood. The FDIC knows how to regulate banks. The Fed knows how to set capital requirements. We're not, jumping into a brand new business model of the government becoming the big carry trader for mortgage securities, which is, I mean, if anybody had walked into a venture capitalist with the business plan that Henry Paulson showed, or that Congress is putting together, they've been laughed out of the office. You've got to be kidding me. So you have no knowledge of this market you're getting into. You want to spend $700 billion. You have no idea how to scale. You have no plans, no understanding of how to value this. You've got to be kidding me. And, so I think that I would try the capital forbearance a lot sooner than I would try the other. I think the other, works better politically, and maybe cheers up Wall Street investors because so many of the people who are investing in stock are also people with a big stake in trading mortgage security. But I think in the long run, for the sake of the economy, I would focus on just getting the banks to be able to lend and not just leave the mortgage securities alone.
So you don't actually think that if this sort of because the plan is being sold with this sort of apocalyptic rhetoric, right? If we don't do this, then we could plunge into the next depression. You think that that's not the case, that you could do something sort of modest by like reducing capital requirements for banks, and that would be a better solution to the mess?
Yes.
We're not going to plunge into 25% unemployment and trying to sell apples at the side of the road.
That's what I'm saying, and I would take Ben Bernanke's opinion on that over mine, but I would certainly want to run that by him and make sure that he is pretty convinced that he does not have the tools to enable banks to lend. And then even if that's the answer, then I don't think we necessarily have a solution, because I don't think the Paulson plan will actually do what it's alleged to do in terms of loosening up the mortgage securities market. Again, it'll just take months to get the thing going. And so I think if the apocalypse is going to hit, I think we're just going to be hit regardless. And I think if it is going to be hit, I'd rather have not spent money on mortgage securities. I'd rather have money I could use for unemployment benefits or relief or whatever. So I just can't come up with a scenario under which I would want to try the Paulson plan. I think even if I thought the apocalypse were coming, I would want to have more government budget available to use to relieve people. Because I just don't see it preventing the apocalypse. What I do see it preventing is a big downdraft in stock prices. But I don't think public policy should be based solely on what you need to do on a day-to-day basis to try to boost stock prices. I think that's a mistake. In 1971, wage and price controls caused a big surge upward in the stock market. Long-term for the economy, they were a disaster, and they stayed in place for 10 years. I think this Paulson plan will have adverse effects for decades if it's enacted, or any variation on it. Again,
well, you're going to have to leave it here. I'm fascinated in the question about why it is that basically any time the government steps in to shore something up, it sort of inspires confidence in the market in the short term. But I don't think we have the time to go into the psychology of that. But Arnold, thank you so much. This was really, really helpful to me. This is like really incredibly difficult to explain, and this is a good example, I think, of an issue where, how can we count exactly on the democratic process when professional, sort of economically focused wonks have no idea what's going on, and you have to turn to classmates of Ben Bernanke to explain it at all. So I understand things a lot better than I did before, and hopefully my prom date will feel illuminated after I pass this along to her. Yeah. So thanks so much.
You're welcome. And again, it's a classmate of Bernanke on crack.
On crack. Well, you're the most sober-minded crackhead that I think I've ever met, Arnold. So
okay.
Congratulations.
All right. Thanks.
Take care.
Bye.